Greetings, friends. It is Thursday, January 20th, and my two words for today are buckle up. We are definitely off to a rather rocky start for 2022 in the markets, and that was kind of confirmed today. We've had some up days, some down days. We've had a little more down days so far this year than up days, but today was particularly ugly. We started the day off on a pretty good note. Markets were rallying. Dow was up 300-400 points. S&P was up. NASDAQ was up. And then the afternoon, the bottom fell out and everything just cratered. So as of the close today, we're really fresh lows for the year. The NASDAQ is now officially in correction territory. We're down a little bit north of 10% for the NASDAQ. S&P is off about 5%. The Dow is off about 4%. But what you're seeing is the carnage underneath the surface is actually a little bit bigger even than what these big indexes would suggest. To give you an idea, the Russell 2000 small cap stocks also down about 10%, and you're at lows now that you haven't seen really since early 2021 in terms of small caps. The only thing that's kind of holding up in there so far year to date is international stocks, and I want to talk about that really briefly because for the first time, international stocks in a couple years have kind of on a relative term sort of flashed a pretty positive signal relative to our domestic equity markets. For those of you that have been watching the markets for the last several years, know that the only game in town has really been U.S. large cap stocks. You've made some money in international securities, but they certainly have not outperformed U.S. markets. 2-3 weeks that we're into the year does not necessarily make a trend, but you are starting to see these international markets hang in there pretty good, and for sure on a relative basis performing much better than the S&P. So what's really happening here? Well, some of the big high-flying tech stocks that have led the way over the last couple of years are really falling out of bed. You're seeing a definite rotation. The only two segments of the market, the only two sectors of the market that have held in there and doing pretty well this year are energy for sure. Energy year to date is up about 15%. Financials are basically unchanged year to date. And then otherwise, that's about it. Consumer discretionary down about 10% this year. IT down about 10% this year. Real estate down about 10% this year. And so what's going on? Well, first of all, what you're seeing is this. You're seeing liquidity being pulled out of the market. The Fed is saying 3 rate hikes, maybe 4. Odds suggest we may even see a 50 basis point rate hike during the next Fed meeting, which would be pretty massive. That's one thing. That's definitely kind of pulling some of the froth off the money supply that we've seen here in the last few years. And also the Fed's not buying bonds anymore. They're looking at freezing their balance sheet. And to give you an idea, when the Fed buys a bond, if we go out and buy $1 million worth of bond for our book of business, it doesn't change the money supply. We've taken money from somewhere else, we bought bonds. When the Federal Reserve buys bonds, they do it with money that never existed anymore. And last year, they were buying bonds to the tune of about $120 billion a month, $1.4 trillion, $1.5 trillion a year. That is now dried up. So you've got less aggressive Fed, concerned about inflation. Again, last year we saw inflation rates of ended up about 7% or so. We were expecting some inflation coming off the deflation that you saw in the very early days of COVID. Economists were expecting about 4.5%. We got about 7%, and it's definitely causing a lot of pain for Americans, no question about that. The Fed wants to get that under control, so they're going to be far less aggressive. We've also seen really a stalemate in Washington, where it's become pretty clear at this point nothing is going to happen in Washington until these fall elections. Pretty much everything is on hold, which I kind of think is a good thing. I think it's kind of a good thing that Washington is not, our politicians, our political class is not going to have a huge ability to change anything major this year. I take that as a positive, but what it does mean, it means less crazy money in the system. So the market's sort of repricing all that as well. And I just think that this is kind of the start of a correction that's quite frankly overdue. Normally in the beginning of the year, I will get a question from people, do you think we get a pullback in stocks this year? Particularly every single year in the 15, 16 years now that I've been doing this end of the business and the 10 years that I was on the institutional side before that, question I always get is, what is the market going to do this year? Are we going to get a pullback? And I'm for sure not going to try to pull out a crystal ball and say where it's going to be at the end of the year, but I usually will answer with some degree of confidence, you're going to get a 10 to 15% pullback at some point in equities throughout the year. And the reason I can confidently say that is because in an average year, you get a 10 to 15% pullback in equities. Can't say for sure. It feels to me like we're in the start of one of those corrections. We did not get a correction last year. We got close a couple times. We didn't get a correction. Obviously, we had a big one at the beginning of 2020 because of COVID. We didn't get one in 2019. We had a big one at the tail end of 2018. So this kind of volatility is definitely normal. In the meantime, until we meet again, stay tuned and look forward to talking to you again next time.